Hi friends, welcome to our today's session. Uh, Let us continue our discussion on short-term funds management. This deals with working capital management. So your syllabus is talking about strategic planning and estimation of short-term fund. And previous session we have already understood that when we see short-term funding, basically it refers to working capital funding. To run the business, I need some capital over long term. So these are the capital which are required for the purpose of, let's say, plant and machinery, land and building. These are long-term requirements. Coming to short-term requirements, the business also needs to buy raw material and some stock also needs to be kept always. And there will be some work in progress. And when you will be selling your products or services, you'll be selling it on credit. So some capital will be blocked in the form of receivable. So all these elements require investment, and these are the investment in short term because very soon you'll be converting all these things into cash. For example, let us say today your debtor is there, but within the operating cycle he's supposed to pay you cash. So it will be converted into cash, but till that time you need finance. Them. You need to think of what are the source of financing. Normally, friends, what is understood in the business, or you need to appreciate one thing that previous session we have understood there is one element of working capital which we call it as the permanent element that is required over long run, and there is short term requirement also. Over and above it, there is a temporary requirement of working capital. Working capital ideally should be financed through short term sources, but if there is a requirement, it can also be financed through long-term sources, provided it is a permanent part of the working capital. And the temporary part of the working capital should be purely financed through short-term financing sources. So that is what you need to appreciate. So let us look at our slides. So this is what I was discussing about what you're saying is that there are many businesses where more money is blocked in working capital. There might be some businesses where fixed capital is less, working capital is more. For example, let us say somebody is doing jewelry business. In jewelry, he has to invest a lot of fund in the stock. So he has to keep the stock. So the investment in working capital may be more than the investment in fixed capital. So accordingly, one has to see the financing structure also. Well, friends. So this particular picture shows you how working capital can be financed. So working capital consists of many things. You have to give some money in the form of cash, in the form of debtors, in the term of inventory. So all these are money required. How they are financed. So if there is some account payable means you might be purchasing some raw material on credit. That's a financing source. You're purchasing raw material on credit, that's a financing source. You might be having a OD limit in the bank, overdraft limit, or a cash credit limit. Okay. So you might have taken some short-term borrowings from the bank. So all these are the sources of working capital, sources of short-term financing. Okay, look at this picture now. How working capital can be managed. Since working capital consists of all these things, cash, raw material, work in progress, finished goods, and debtors, all these things need to be managed efficiently. Okay, all these things. You have to have efficient cash management, efficient raw material management, efficient stock in progress management, finished goods management, and sundry debtors management. Because in everywhere, in all these areas, some fund is blocked. And you require this money over short term. What happens when a person starts business, it brings some cash is converted into raw material converted into semi-finished goods or work in progress. The semi-finished goods is converted into finished goods are converted into debtors, and debtors gives cash. So this cycle is referred to as working capital cycle or operating cycle or cash to cash cycle. Okay, cash is invested, again, cash is received back within the operating cycle. Till that time, you need investment. That's why it is called as the short-term financing requirement. Right. Now, friends, this picture is showing you various methods of estimation of working capital. One is operating cycle method. If you know the operating cycle, which I showed you right now, that is cash is to be converted into raw material into stock in trade. I'll be showing you another picture of operating cycle. Just wait a minute. Let me try to show you that thing. Here also you can see the operating cycle. Initially, you have discussed this. Cash is converted into raw material to work in progress to finished goods to debtors. This is how cash circulates, right? So once again, I'm taking you to that old slide. So if you know your operating cycle, that means for how many days you have to keep the raw material, for how many days you have to keep the work in progress, for how many days stock is to maintain, and what is the debtors recovery period, debtors turnover period. If you know all these things, you'll be able to estimate that how much investment is required for all this. For example, if you feel that raw material has to be kept for 2 months, so that is the investment. 2 months raw material demand is the investment. Or if you feel that this much of stock has to be kept, finished goods has to be kept for 15 days, right? So that is the investment. For 15 days finished stock, how much cost is involved? That is the investment. Let us say debtors will be paying in 30 days. That means for 30 days, if you have to keep on investing on your sales, so that is the requirement. So one way is to know your operating cycle and estimate each component of it. What is the period and how much money will be. Other way is that ratio of sales method. If you know the sales and if you are having fair idea about the business, you'll be able to understand that if this is the sales, this will be the raw material requirement. And this for this much of sale, this will be the sundry debtors. So you can establish a relationship between the sales and the components of working capital. Let us say raw material is 20% of the sales. Let us say debtor is 30% of the sales. So like this, you'll be able to estimate each and every component of working capital. That is another method. The third method is the ratio of investment method. Here, what do? You find out what is the investment. Okay. And try to establish a ratio of each component of working capital with the investment. If this much of money is invested, let us say 10% of it is raw material. Let us say 20% of it is finished goods. Let us say 15% of it is sundry debtors. On that basis, you'll be able to estimate your working capital. So you got some idea about estimation. Okay. So this particular slides, you can read it at your free time. I'm not going to read it for you. This explains how operating cycle can be. So if you look at here, in fact, it says that R plus W plus F plus C plus D minus C. This means, you see, cash is there. Okay, once again, I'll say R stands for raw material, W work in progress, F for finished goods, D for debtors, minus C is for creditors. So you see working capital cycle, once again, you can see cash is converted into raw material to work in progress, work in stock to debtor. Everywhere some money is invested, that is your working capital requirement. Since you feel that some of the raw material can be brought in credit, therefore you may feel that there is no requirement to have working capital to that extent. Therefore, C or creditors are reduced. Debtors are added, but creditors are reduced. Debtors are investment you are making. Creditors is a benefit to you. You can manage the business without having this much of working capital. Therefore, creditors are reduced. So by using this operating cycle, by calculating the duration of each element of cycle, you will be able to compute your working capital requirement. Okay, so each period is computed. Suppose raw material storage period is computed by using this formula: average stock of raw material divided by average stock of raw material consumption per day. That means if per day this much of raw material you are consuming, so how many days raw material you would like to give? This is the estimation of that. Similarly, work in progress holding period can be calculated by taking average work in progress in stock divided by average cost of production per day. Same way, finished goods storage period can be computed, debtors collection period can be computed, credit period avail can be computed. Once you know all these things, you can have a look at this formula. You can find out the total operating cycle. Now, operating cycle will be 1 plus 2 plus 3 plus 4 minus 5. Okay, you will be able to compute your operating cycle. So, with the help of operating cycle, you will be able to compute your working capital requirements. Okay, friends. Now, from here, yeah, just look at this picture. Assessment of working capital. You have to compute your current asset. These are the components of the current asset, total current assets available. You have to compute your current liabilities. That detail is available. And the difference is your working capital requirement. Just have a look. Okay. Now again have a look at the sources of financing working capital or sources of short-term finance. On the left-hand side, what is so this is actually the long-term sources like equity, debt, term loan, short-term borrowings. Permanent part of the working capital can be managed with this. And the temporary working capital should be managed with short-term financial like trade creditors, bank loan, commercial paper. Commercial paper is an instrument which can be issued in public. Depreciation as a source. Depreciation is also a source. That means to the extent you are charging depreciation, that much of money is available with you. Depreciation is an expenditure without involving any cash flow. So that depreciation fund which is created, that can be used as a working capital source. Deferred tax liability is similar to that. It's a kind of provision you can say. Your tax liability is deferred, it is delayed, and you are creating a provision for that. When you're creating a provision, your profit is reduced no doubt because of this provision, but funds are available, cash flow is available. There are miscellaneous sources like let us say dealers, deposit, advances, through which working capital can be managed. Okay. Now I'm only showing only those slides which are relevant so far as your syllabus is concerned. Now, this is again one more way of explaining estimation of working capital. One is percentage of sales method. You can find out each component as a percentage of sale or item-wise computation method. Both way you can will be able to compute your working capital. Percentage of sale method, I had already explained you that each component of current asset and current liability will be presumed to have a relationship with sales, and in a particular ratio they will be computed. Consequently, your short-term funding or working capital requirement can be computed. Okay. Questions are available uh, in different videos. You can look at it if you're interested. Okay. Otherwise, we'll be only covering those areas which is required as per the syllabus. Yeah, I think fairly we have covered all these components. What is required right now. So again, what I'll be doing, let me explain this thing. One more thing is there in the syllabus, that is cash management, inventory management, receivable management. These are the components of the treasury management. We are planning to take one more session where we will be covering these things. But before that, if you look at your syllabus, you have already covered the strategic planning and estimation of short-term funding and financing sources, right? Financing sources we have seen. Okay, one more thing. Cost of this short-term funds. What is the cost of the short-term funds? So when short-term funds are arranged, its cost include, first of all, if it is a bank loan, then what is the cost? Interest is the cost. If it is arranged, let us say you are giving cash discount, so that cash is recovered promptly from the customers, then that discount is your cost, right? Similarly, commission, brokerages, all these things you are paying to finance, arrange a short-term finance. All of them are your costs, right? These are basically the cost of working capital, cost of short-term finance. Okay, just a minute. Let me check off. Give me 1 second. I think there will be a slide on the cost of working capital. Let's see. Okay, so this slide you can refer. Just give me one more second. Let me share the screen with you again. We're talking about cost of working capital financing. In that context, I'm going to share the screen, which I had already discussed. Just can look at here. Yeah, I got it. I think you'll be able to see it now. So cost of financing working capital, interest and cash credit loan, commission, brokerage, discount, bank charges. These are the costs. We have already discussed all this. Right, friends? So with this, I think we have completed this part. And one more element is there, that is management of cash inventory receivables. So we'll be covering shortly. Thank you.